Tax time tips for real estate. Real estate sits at the cusp of taxes, investments, and leverage. Your tax returns will look materially different if you structure well. Here is a real estate focused practitioner's breakdown tailored on how high income professionals should think about real estate during tax season. Mortgage interest deduction. Use it strategically. The mortgage interest deduction remains one of the most powerful tools, but only when understood correctly. Interest is deductible on up to a 750K of acquisition debt for primary and second home. It works best when you are in a higher income tax bracket. You itemize the deductions, not use standard deductions, and that is when this works. This is where your rent the money, don't rent the house philosophy becomes tangible. That's from my book. The government effectively subsidizes part of your borrowing cost. So that's how that one works. SALT tax. The SALT tax is now $40,000 for income less than $500,000. And if the income exceeds $500,000, then the SALT tax cap is $10,000 only. In Silicon Valley, this cap hits very quickly. And up to $40,000, if you can get that one, that's a phenomenal tax break that you can get. Do not overvalue property tax deductions in your buy versus rent. Focus on appreciation, leverage, tax-free gains. We'll talk about it in the next section. The capital gains exclusion, the section 121, the hidden wealth engine. The primary residence capital gains exclusion is arguably the most underutilized wealth lever. Exclude up to 250K for a single and up to a 500K for married. Guess what? You have to just live 2 out of the last 5. So essentially, you can sell and move into another residence every 2 years and take this 500K in tax exemption every year in capital gains, every 2 years. Advanced move, you keep moving across homes and harvest tax-free capital gains repeatedly. Fourth, depreciation. The investor's silent weapon. For rental properties, depreciation is a core advantage along with interest, maintenance, and property taxes. Residential property is depreciated over 27.5 years, creates paper losses even when the cash flow is positive. Layer this with cost segregation studies, accelerate depreciation, bonus depreciation, which is being phased out now, but is still relevant to some extent. The outcome is reduction in taxable income significantly, improve after-tax yield versus other asset classes. So passive loss rules. Where most investors get stuck is the passive loss. Governing passive loss activity rules. Losses from rentals are typically passive, can only be offset by passive income, not W2 income. Most professionals have W2 income. So that's what. Exceptional strategies. Real estate professional status, short-term loophole. These are the things that you can use in investment properties. 1031 exchange to defer taxes to continue to build wealth. 1031 exchanges allow deferral of capital gains when reinvesting into another property. So you don't pay taxes today, you keep building your appreciation. You trade up single family to multifamily, residential to commercial. This is not tax elimination, it's deferral with compounding leverage. So just imagine, your property keeps appreciating at a compounded rate. Cost basis optimization, often ignored. Your taxable gain is sale price minus adjusted basis. Increase your cost basis by capital improvements, closing costs, certain financing costs. The result is much lower capital gains tax when selling a property. Short-term rental strategy. This is an advanced feature. Short-term rentals can sometimes bypass passive loss limitations because that is an active property. Allow losses to offset active income, requires leverage, average stay is 7 days or less, active participation. This is a powerful hybrid tool between real estate investing, business income treatment. So that's that. Timing matters. Tax year execution strategy. Before December 31st, prepay property taxes if beneficial under the SALT cap. So you have to consider how that is going to play out. Close on purchases to capture deductions. Execute cost segregation. And after Jan 1st, plan disposition as to when you want to sell. Evaluate 1031 windows. Structure ownership entities. And you need to remember to pay your taxes. So real estate is a tax engine. The real tax advantage isn't one deduction, it is the stacking effect. Leverage from borrowed capital, inflation from erosion of debt, and tax deductions, interest, depreciation, tax-free gains, and tax deferral. So, if this does not convince you more about using real estate as a tax optimization tool, you should perhaps be talking to me and I can probably give you more insights. But before I close, I want to give you two very important tips. If you have not already filed your returns, and if you refinanced or purchased a home this year, you must make sure that you took the points, closing costs for the financing, and fees in your reported it to your taxes, because that also gives you a tax break. If you like this, please subscribe and share with your friends who need this piece of advice. Thanks for watching. See you on my next one. Bye.